Okay. Well, this is a little bit of a change from what we were going to do, but yeah, my name's Michael Hironimus. I'm a principal broker and investment advisor with Duckridge Realty Advisors. Uh, Basically, what we do is, even though we're quote unquote a brokerage, we really don't do a lot of brokering. We mostly focus our business around portfolio and asset management. And if you've never heard of that before, essentially what we do is it's a lot based around goal setting for investors in commercial real estate. It's asset management, making sure that their properties are running properly, and essentially taking over a lot of the operations and analyses for investors so that they can go and do what they want with their lives and maybe take something off their plate. So I also teach for, I'm a CCIM. I don't know if everyone knows what a CCIM is, but it's a Certified Commercial Investment Member. It's a designation that holds a lot of weight in the commercial real estate investing arena. Very difficult to get and sort of the gold standard for investment real estate. I also am an instructor for them. I teach the 102 core class, which is market analysis. And market analysis basically runs around supply and demand characteristics, market cycle, economic base analysis. And so it's a lot about, we'll be talking about some of the investment metrics, and David wanted me to come in and talk a little bit about, cap rate and measurements and so forth. Market analysis essentially tells us what numbers to put in the financial analysis. So it really is sort of the precursor to putting a lot of these numbers in when you're trying to analyze commercial real estate. So that's what there are 4 core classes for CCIM, along with another 100 classes, including negotiations, which we'll be teaching later on this year. The other core classes, the first one is financial analysis. That's sort of our bedrock class. It teaches a lot of what I'm going to go through today. It basically teaches you about a lot of the analysis and breaking down commercial real estate from not only the investment metrics, but also breaking down rent roll, profit and loss statements, tax implications, just a lot of information. And then the second course is 102, which I just mentioned that I teach. 103 is leasing analysis. So that's a great opportunity for people to learn about comparing one lease to another, especially for both the brokers and investors. It's important if you have multiple offers, how do you break those offers down and how do you compare them on an apples to apples basis? There's also a lot of sale leaseback analysis. There's also lease versus buy scenarios where, okay, well, if you're an investor or if you're an owner user out in the market and you want to figure out, well, what makes the most sense financially? Is it better to lease or is it better to buy property? That gives you that insight. And then 104 is essentially the 101 on steroids, if you will. It's called investment analysis, and it puts a lot of the previous ideas into practice. There's a lot of case study work, go into a very deep dive into investment analysis and use it against the case studies and real world life scenarios, which is really what we're all trying to accomplish.
Hey, Michael, can you hear me?
Yes, sir. Yeah, I can hear you.
You can hear me. So, oh, hey, that's good. You can hear me. So, all right, just checking.
Can everybody hear you?
I don't know. We'll find out.
Okay. I don't know if you want to go a little more. I'm next year's just chapter president. I sit on the board for the Institute, and I've got a little society that I run where we do a lot of this ongoing education. We bring in a lot of guest speakers, similar to what David does, but we do this in person, so it's a little bit of a different format. Unfortunately, you have to be in Oregon or the Portland metro area to attend, but we also do have a lot of education. I'm teaching one, which I'll show at the end, on risk analysis. Been in brokerage, been in investments for a long time, so hopefully I can at least give you one little nugget to take away today. So thanks for the opportunity, David.
Oh, my pleasure. So I guess the audience can hear, Michael. So one
Great.
thing I just, the title of this thing's "What the Heck's a Cap Rate?" And I just wanted Michael's, I mean, the best of the best. He's an instructor for CCIM. So I thought, for our clients and for brokers out there, I just think CCIM is a tremendous platform. And, it's important for people to be aware of what's out there in a market like we're in. You've got so much pressure on property, and I just want to, get somebody in there that's going to be able to help people understand that the numbers aren't always the numbers. And I took a lot of statistics in college, and it's one of those situations where you can pretty much show whatever outcome you want if you pick the right sample group. So the idea was today that we're going to talk about cap rates. Michael's going to talk about cap rates. I don't want to do that. And then he's going to talk about some other forms of property valuation too, and talk about a little bit about how property valuation cap rates can be impacted, or you might be able to cook them a little bit with different things. So the idea is today you've got an expert here on this thing, and if you've got questions, I'll be monitoring the question side, and I'm going to be asking Michael some questions too. But he's got a nice PowerPoint. We'll get it going. All right.
Sounds good.
So carry on, Michael.
Okay, so you had come on and asked me, if I could explain cap rate a little bit, and cap rate's a little bit of a nebulous idea because it's one that's thrown around a lot, but I'm not quite certain everybody understands what exactly a capitalization rate. When we're talking about a direct capitalization rate, we're talking about an investment metric that deals with the property itself, and that's a big distinguisher from a lot of the other investment metrics, because a lot of the other investment metrics are particular to an investor themselves. A capitalization rate is a metric that's particular to a property. And the reason that capitalization rates are used so widely is because it really is, first off, a very simple calculation. And second off, you're able to do an apples to apples comparison on different property types and different assets in different areas. And we'll talk about a little bit about what that means in terms of ramifications and looking at capitalization rates. But a couple of the definitions I had come up with in the past, and everybody's got a little bit of a different definition, but it's the rate of return that's expected to be generated within a 12-month period on unlevered investment property. And once again, it's on the investment property. It's not particular to an investor, and we'll make that distinction in a little bit. But essentially what it does is it converts future income stream into a present value. And David, you've been asking me, well, how does that come into play in terms of evaluating your initial investment and getting into that investment and figuring out if you're doing a good deal? And I will say that it's not always a great metric for understanding if you're getting into a good deal. So the calculation's easy. You've probably already seen this. Cap rates, your NOI divided by your property value. There's the old Uncle Irv in the corner there, and essentially the idea is if you look at that square and you put your thumb over one of those, it'll tell you how to solve for the other one. So if you put your thumb over value, you'll see that income divided by the rate will give you that value. If you want to figure out the cap rate, just put your finger over that, and it's income divided by value. So you can play around with that. Those are online, but good little quick ways to figure out what the cap rate is and how it converts to present value. So,
hey, Michael. So
yes,
somebody had a question. It says, it seems to me the CPAs understand cap rates differently from a commercial broker. Has anyone else noticed that, or have you experienced that?
Yeah, that's a good question. I think a lot of the CPAs that I deal with, they're not real estate professionals. And so what capitalization rate, I don't know, I'm not a CPA, so I don't know how quite they use it in CPA terms, perhaps there's a slightly different definition for them, but they're not real estate professionals. And so, capitalization rate, once again, is a return on the property. Most times CPAs are looking at it from an investor's perspective. They want to take into account their, tax professionals. They want to take into account tax. Maybe they want to take into account cost recovery, depreciation. And those metrics aren't in a cap rate. And, when we talk about breaking it down, the cap rate is based on the net operating income. And, personal taxes are not part of that. And so CPAs will look at it slightly differently. In fact, I don't know a lot of CPAs that do a lot with cap rate just because it's particular to the property. But perhaps there's some CPAs out there that can offer a little insight into that. I hope that answers the question.
And I guess another gentleman said, he would like an example of if you could just run through. I mean, you probably got it in the presentation, but just jumping ahead.
An example of a cap rate?
Yeah, just calculating one. Yeah.
I don't have one, but if I go back here, so let's say that the net operating income is 100,000. And let's say that the, and we take 100,000, I'm just doing a real quick and dirty calculation here. We take 100,000 and let's say that the property we divide by, and the property is listed for 5 million. So what would the cap rate be on that? It's basically 2%. If we do it and it's still 100,000 the NOI, but it's a $2 million property. What's the cap rate on that? It'd be a 5% cap rate. Okay, so you can play around with that. Now, what we're going to show, at least I hope I can convince you, is that the cap rate can be manipulated in a lot of ways. There are a lot of weaknesses with cap rate. The one thing that I really want to hope that you take away from all this is that never take for granted the numbers that are being presented to you. And for me, as a professional and doing this on a regular basis, it seems crazy to say for me, but I've heard of way too many investors that simply take the numbers that are given by the listing broker or have you and just run with it and see if it's a good deal. And that makes me sort of sick to my stomach because a lot of ways cap rate can be manipulated. We'll talk about that in a second. So we were talking about it, and so, just some of the weaknesses of cap rate in terms of how it's utilized. Well, one is that it only considers the first year of net operating income and no changes to that. So what you're buying when you buy a property is you're buying the first, you're buying the income stream. Capitalization rate only looks at that first 12 months of income stream. And so there's a couple problems with that. Well, I guess what I talk about when we're talking about sort of internal rate of return, that's another investment metric that we use a lot at CCIM. If internal rate of return is a movie, the cap rate is like a photograph because it just takes a snapshot of a certain period in time. It really doesn't tell you the whole story. Maybe it tells you how the story begins. And a lot of times some of the story begins really well and then the story falls off at the end and it's a horror movie. But capitalization rate really is just a snapshot in time, and that's based on that first 12 months of net operating income. So that's one thing to consider. The second thing is that it doesn't consider any financing or tax implications to the investor. And once again, when we're talking about cap rate, what it is it's a return on investment of that particular property. That's why it's actually helpful, is that it takes the investor out of the equation. It just looks at the property and you can compare it to another property in another area or another asset class or across the country. And you can sort of compare that apples to apples cap rate. So that does have some usefulness, but in terms of the investor themselves, it really is not that useful when you're looking at it in terms of what you're actually yielding on the property. So that's one thing to consider. It can be manipulated by changes in value or income. I'm going to go through, I just recently, I know, David, you've talked on this in the past, but, I'm going to go through some of the issues that happen and how they can be manipulated. And I wrote down 4 that I see on a regular basis. There's a number of ways the cap rate can be manipulated. Maybe, David, you can even throw one into the ring here, but I'll show you how those can be sort of manipulated. And I see it all the time. You go into LoopNet and you can see all different ways that cap rates are manipulated to make it look good, right? They're trying to sell you, goods. And so, we'll try to break that down and make you a little smarter when you leave. So if there are all these weaknesses with cap rates, why is it widely used? Well, it's a simple calculation, what we had talked about before. It's a calculation where you just take the NOI, divide it by the value, and boom, there you got it. And you can work that around so that if you got the cap rate and you got the value, you can figure out the NOI and so forth. You can play around with those numbers. So it's a simple calculation. A lot of people understand it. You can do it on a regular calculator, and it makes it easy once again. But with the simplicity is why there becomes problems with it. It's widely accepted in the industry. So, you talk about cap rate, you talk with a broker, you talk with an investor, you talk with a, property manager. They all know cap rates, right? We all talk about it. It's widely accepted. And so that's another reason that it's widely used.
So Michael, real quickly, I mean, when you're talking about even like closing costs, we had a question come in, how does a broker's commission factor into it? I mean,
well, for you, for the acquiring investor, you're not going to typically pay brokering commissions. That's usually going to be paid by the seller. So those are separate from the NOI cap rate calculation. Yeah, but you bring up a good point. When you're talking about, other things that are particular to the investor, those aren't included in a cap rate. So those are things to consider. Now we'll talk about disposition cap. So there's 2 cap rates, right? There's your acquisition cap rate, which is your direct cap, and then there's your disposition cap rate, which is what are you going to sell it for in the future, and what is that capitalization rate going to be? When you do it in the future in your capitalization rate, you are going to want to take into account some of those closing costs and some of those commissions and so forth. So once again, I just wanted to emphasize this because this is a big takeaway, and I think that's where we're sort of missing the boat in a sense, is that cap rates rarely, if ever, take into account investor yield. Investor yield is going to take into account tax implications. It's going to take into account leasing and leasing fees. It's going to take into account, a number of other things that are not included in the cap rates. So we have other tools in our toolbox to be able to figure out how the investment works for the particular investor. And I'll go through a couple of those series with you. But cap rates rarely equal investor yield. And so when we're talking about cap rates, the first thing that we do is look at it and go, okay, well, that might be a property to take a look at. I don't know, it's a 6 cap in a 5.5 cap place. Maybe they're doing it to get somebody's attention. So maybe that's something to take a look at. But then you got to start getting and diving into it. And that takes a lot of other tools in your toolbox. As they say, if everything's a nail, then that's great. All you need is a hammer. But in investment worlds, not everything's a nail, and you can't use cap rates for everything to calculate.
So with that said, Michael, I mean, if you're looking at a given type of asset, do you use? I mean, obviously you're using a combination of valuation methods, but I mean, are there certain assets that you use certain formulas for?
Well, when they're particular to the asset class, really cap rate is the one that is usually used to determine apples to apples comparison among the asset classes, okay? For example, if you go on and you look at a cap rate in Portland, for multifamily, and it's trading at a 5, and you go to Oklahoma and you look at a multifamily investment, it's trading at a 7. Well, that tells you a few things, and it gives you an apples to apples comparison. But when you're looking at the property itself, cap rate is really one of the few metrics that is widely used. One that's a particular asset class, the only one that comes to mind is GRM, gross rent multiplier. That's usually used mostly for multifamily, although it can be used for any asset class. It's just the GRM and the potential rental income. But the GRM is used mostly in multifamily. But when you're talking about asset classes themselves, David, those are just really particular to cap rates. Now, if we're talking about what I like to think about is how do different metrics for different properties affect the investor, because then that's a different calculation. For example, if you're determining whether you're going to buy multifamily or whether you're going to buy an industrial building, well, there's differences there. There's differences in taxes. There's differences in cost recovery, right? Multifamily is based on a 27.5-year depreciation, whereas industrial is based on a 39-year depreciation. So there's differences there when we're talking about investor yield, but not so much when we're talking about properties. And that's why cap rate is really used, because it gives you that apples to apples comparison across the board.
Got it.
Just in terms of, and I get this question a lot, because just in terms of how cap rates are built, I wanted to talk a little bit about that. Now, I don't want to get in too deep of a dive, but a lot of people ask me, well, how are cap rates derived? And they don't live in a vacuum. They definitely don't live in a vacuum. In fact, they're built throughout the capital markets. Investors, for the most part, dabble in a lot of the major food groups: bonds, real estate, and equities. And if one of those is getting a better return than others, or an overbalanced return on others, then money will flow in that direction, and you'll see that change in returns. So it doesn't live in a vacuum, and cap rates are usually broken down like this, and I'll show you how this goes. So inflation is a big hot topic right now. Inflationary pressures are starting to mount as we have supply chain issues. We have people that are out of work and not going back. We have wage increases across the board because businesses are having a tough time trying to find workforce labor. And so, inflation, whether you want to believe it's transitory or if it's here to stay, I believe that we have a big inflation problem coming up. And I was just in Chicago listening to our chief economist, and he was saying, yeah, it's here to stay. We haven't figured out all the supply chain issues. And there's, a lot of issues with the Fed and how they're looking at this. He used to be on the Federal Reserve. In fact, during Greenspan and during the housing crisis, great financial crisis in 2008. So he knows what he's talking about. He's seen this before, and he actually made the case that this is starting to look a lot like the late 70s and early 80s of inflation. And he laid out that case pretty definitively. So we'll see how inflation goes. But when you take inflation and then you take the real rate of return, that's where we base across our risk-free rate. And our risk-free rate is typically used as the 10-year U.S. Treasury benchmark. Because it's backed by the full faith of the U.S. government. We typically use a 10-year Treasury because it roughly coincides with a holding period of real estate for the most part. There's a 5-year and a 7-year benchmark, of course, but typically when you're talking about risk-free rates, you're talking about the 10-year Treasury. By the way, do you know what the real rate of return is right now, David?
Nope.
I just looked it up yesterday, and it's been worse. Believe me, I think at one point it was negative 1.8, but we're down to negative 1.2.
Wow.
So what that means is when you take into account inflationary pressures and you're buying corporate or buying U.S. Treasury bonds, you're actually losing about 1.2% currently. So if you're thinking about buying bonds, slap yourself across the face and call me, please.
Tangible assets, Michael, tangible
That's
assets.
right. That's right. Thank you. So what happens with the 10-year treasury rate is we build that up even further, and there's something called a property risk premium, and that's essentially the risk that's associated with this type of asset. There are different risk premiums for different types of assets. Obviously, the bond market is typically more of your less risk. Real estate is usually right in the middle, and then you have your equities, your stocks, and so forth that are typically included as the highest risk asset type. So when we're talking about cap rates, we're talking about property risk, and that is where basically the risk is baked into the cap rate. There's another premium on top of that, which is a illiquidity premium. You know, we have a very illiquid asset type compared to stocks and bonds. You can wake up tomorrow morning and sell a stock and a bond. You can't wake up tomorrow morning and sell a commercial real estate building. There's usually a long runway for that when you come to selling a property. So there's a little of a risk premium there that we add to illiquidity. So when you take out the inflationary premium, what you're left with is essentially the cap rate. So it's the real rate of return plus the property risk plus the illiquidity premium. And that's usually how cap rates are built. Now everybody's talking about cap rate compression. And a lot of that has to do with your interest rates. And a lot of it has to do with the real rate of return on the treasury market. Because we're at a negative real rate of return right now, there is still some property risk premium that's built in there that we're still doing a pretty good job on. So is that to say cap rates can compress further? I think it can, especially with the amount of liquidity that's out there in the market. If you take all three of those, what we do is we discount, and I talk about this a lot, and I can do a class on this discount rate and holding period rate. That's where you take in a lot of the risk, including inflationary pressures, and you discount those future cash flows to analyze a commercial real estate property. So there you have it. That's how cap rates are broken down. This comes straight from NIOP and is pretty widely known in terms of how you decompose capitalization rate.
So Michael, tell us a story of a deal you worked on where the property was being marketed at a certain cap rate, and when you got into it, you found something totally different.
Well, you know, I worked.
And what was the cause of that difference?
Yeah. Great questions. You know, I wish I could go back and talk to every investor that I talked to before being a CCIM, because I really feel like, especially early on in my career, I worked for a decade at Kidder Matthews. I know a lot of you know that brokerage, and I wish I could go back to those investors and say, I'm so sorry. I wish I had done you a better job than I do now, because there were some things that you can easily miss if you don't know what to look for. For example, you know, one of the things that we deal with a lot when you're looking at LoopNet, they're trying to present the numbers in a positive light, right? And so what we get a lot, and I've had this happen to me in the past, where we're looking at it and we understand later on that these are all pro forma numbers. They didn't necessarily state that up front. We thought we were looking at a cash flow sheet, but they were actually pro forma numbers. So this is what the cap rate is if you raise the rents, if you increase occupancy, if you do X, Y, and Z. And so, and we see that a lot. We see that a lot when you're looking at LoopNet listings, and maybe even some brokers do that. And it's not necessarily that they're being misleading. It's just that they're looking at some pie in the sky numbers. Well, my question to you then would be, well, if that is what the property can do, well, then why didn't the owner do it, right? if the property, if you can raise rents, well, why didn't you do it? Because from a multiplying effect on the cap rates, if you increase the rents or increase the occupancy, there's a multiplier effect, and you can sell the property for way much more. So there's always that question. Okay, so if these are pro forma numbers, why isn't the owner doing it himself? Now that, there's chances where there's a real life answer to that, where they say, he's just an absentee landlord, or he just doesn't have the time, or his kids are running the property and they're in the ground, he just wants to get rid of it. Sometimes there's a real reason for that, but that's one of the things that we see a lot. The other one that I see all the time, investors come to me and they go, hey, this looks like a great deal. I'm thinking that this is something that I might want to take a look at. And I go, okay, good. We're looking at this. And they go, yeah, it's a 6 cap and blah, blah, blah. And I'm going, okay, well, let's break down what this all means. So when you're looking at a cap rate is based off of the net operating income, right? And so when you're looking at the NOI, what does that entail? It entails your income, it entails your expenses, and that's how you derive your NOI. It doesn't take into account debt or tax implications or anything like that. And so when we're looking at our expenses, what I notice time and time again is that when you get an offering memorandum or you get a flyer or whatever, what are the expenses based off of? Well, the expenses are based off of the guy that owns it right now. And so what happens when the property sells? Well, your expenses are going to change, right? Your expenses change maybe even quite a bit because of their basis in the property. If you sell the property, how often, David, have you ever seen real estate taxes go down or stay the same? I mean, almost never, right? So
Correct.
what you understand is that when you're selling the property, the basis in the property is most likely going to change, and that has huge implications for your NOI. The other thing is if you're looking at their insurance, well, you might have different insurance rates than they do, right? Your premiums may be different than the previous owners. And so you have to go and you have to calculate that and then find out what the real NOI is after you buy the property. Those are the two biggest things that I see the most that occurs when you're talking about calculating a cap rate for investors. And it's the biggest miss that happens all the time. And people really get hurt by that, right?
Yeah, I think that. I think the comment you made that everybody needs to understand is it's a snapshot at a time. You talked about the IRR as a movie, but the cap rate's a snapshot, and it's for that person at that point in time. And your point on the taxes on these properties, I mean, historically, what the government looks at those valuations and the transfer prices. But there's lots of talk of this mark-to-market stuff too, which is sort of scary. We had a question come in that just a gentleman wanted to know if you could provide just a simple math example on a couple of cap rate compression scenarios. What would trigger those?
Well, those are going to be market driven, so it's hard to do that. But from a cap rate perspective, what I would say, and I do this a little later on. I don't think I have any slides on this, but what I will do is when I'm looking at it, not necessarily from a cap rate perspective, but from an IRR perspective, an internal rate of return perspective, because that's particular to the investor that's buying the property. We'll do a worst, likely, and best case scenario. And what that does is that takes into account not necessarily cap rates, and I understand you're asking about cap rates, and those change, of course, but what we're really looking at is, okay, well, what happens if, I had written a blog post about this, and maybe I can direct you to there, but, we had taken a scenario, which I had worked on previously, where we had a grocery anchor tenant. And, we were looking at, probably a 7-year hold based on our debt. And it was, okay, well, this tenant has an option to renew in 5 years, okay? So is there some risk there? Yes. If suddenly your anchor tenant moves out in 5 years and you've got a 7-year holding period, that becomes very difficult, right? And so what we did was we went through a worst case scenario, a likely case scenario, and then a best case scenario. And it basically was the worst case scenario was, hey, the tenant moves out and we're stuck with a vacant anchor site. And and as everyone who's ever invested in a property and loses a tenant, you know that you don't necessarily get a tenant in there right away, right? You've got marketing costs, you've got leasing fees, you've got credit loss, or I'm sorry, vacancy loss, and so those things have to be built into your rate of return. And then what we do is a likely scenario. We had talked with the manager of the property and he said, you know what, we've been here a long time. We're part of the community. We have no interest in moving the property. And we're most likely going to go ahead and exercise that option. Well, that's the most likely scenario. And it was at market rates, which, we had said was traditionally 5% in that market. So what we're anticipating is when the 5 years comes up and they exercise their option, we're most likely going to be at about 5% incremental increases. The best case scenario is that they stay and the market moves faster than what has traditionally been happening. Let's say instead of a 5-year increase, rental increase, it moves at a 7% because we're really bullish on that area. We're seeing some good fundamentals. Maybe an employer is coming into town, it's boosting property value and so forth. So that's how we break it down for a lot of investors, and that comes down to a risk assessment. Cap rates don't take into account risk for the investors. They take into account risk for the property itself. And so when we're talking about, worst case, likely, best case, that gives a good picture of what it's going to be at when you go into the property. And it's about going in eyes wide open. Hey, look, does this property still make sense if the worst case scenario happens? Does the property still make sense if the best case scenario, and so forth? And we sit down and we talk about that a lot. And so that's my recommendation, is that you go into it and you look at those different, because there are different scenarios for every property. Nothing goes exactly to script, hardly ever, in fact. And so you have to be aware of those different scenarios and sort of plan for those.
Yeah.
I hope that answers your question.
Yeah. So I used to do a lot of scuba diving. So plan the dive the plan, right? But you always, factor those things in. You think it's going to be a certain way, but it's always a fluid situation. So, along that line, we had a question come in. How does one figure out the NOI on a strip mall in the Midwest if cap rate is manipulated, even if the financials state a certain cap rate? So, once again, it's like using NOI to sort of verify what that value is if the cap rate's suspicious.
Well, I mean, you can go back and you can request their, their K1 schedules, and you can look at their profit and loss from their CPAs and so forth, and you can see that if the P&L or the worksheets that they're sending you, the rent roll, and verify if those are actually lined up correctly. But once again, they're not going to tell you, Mr. Investor, what your new tax rate is. They're not going to tell you, Mr. Investor, what your new insurance rate is, right? Those are due diligence items that you have to go through and you have to make sure work for you. A lot of times the calculators can be found on the county website. You can go in and you can reset your basis based on the selling price and see what that ends up being in terms of the property tax rates, and get some quotes for insurance. Also, you might, we see this a lot where property management fees aren't included in the expenses. Well, if you're buying a property that's all the way out in Oklahoma and you live here in Portland, well, are you going to have to take on those expenses? Well, absolutely you are. And so you want to factor those into your NOI as well, because that affects your cap rate on the property.
So you really need to look at the numbers and see what has been omitted, or what you're going to be doing things differently than the current owner, and it's important to factor in what your experience and your costs are.
No doubt, no doubt. And that's why it pains me so much when you talk with investors and they just sort of take it at face value. Because often or not, what is being presented is not actually what you're going to end up with.
Got it. So we had somebody reach out and say, I've found some people think a higher cap rate is more attractive, like 9%, when my understanding is a 5% cap rate is far superior? Why do people have such a different understanding?
Great question. So,
ding, 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 ding.
Ding, 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 ding. So when we're talking about, so looking at what hopefully everybody's still seeing my screen and what cap rates are right there. Can anybody tell me what the overarching theme in each of those things that we build up is?
Not getting a response. I see the screen.
Anybody tell me?
Nobody's responded so far, Michael.
Is anybody hearing me? Hopefully I'm still talking to people. Well, okay, so I'll answer my own question. And the overarching theme in all of these, how we build up cap rates, is risk. Illiquidity risk, property risk, real rate of return, which is, basically risk, essentially. It's risk-free, but it's risk, essentially. So everything that builds up a cap rate is risk. So when you're looking at, and this is what we do for our business, is we look at it from a perspective of, okay, well, what is your risk parameters? So, if you're somebody who is a 25-year-old and somebody who's a 75-year-old, are you going to have different risk perspectives? And the answer is likely yes. You're going to have different risk perspectives. Typically the investor life cycle goes from, building asset value to then maximizing cash flow to then, protecting assets. And so your risk is going to differ. So when you look at a 5 cap, compared to a 7 cap, the inherent thing that you're going to know is that the 5 cap is less risky. If you buy a 10 cap property or 7 cap property, you inherently know that it's more risky. And so that's why when somebody says, well, a 5 cap looks great to me, or a 7 cap looks great to me, they're looking at it from different risk perspectives. And that's one thing that I think is sort of misunderstood with cap rates, is that it's a reflection of risk for the property itself. And that's a great question, because a lot of people will tell you that it changes from investor to investor and from asset type to asset type. Hotel last year, very risky. You saw cap rates shoot up. Office, CBD office, cap rates are increasing. Retail, has been more or less steady, but that has a higher cap rate. What are the ones that have lower cap rates? Right now, industrial and definitely multifamily. They're typically seen from asset types as less risky asset types than the other ones that I've identified.
So Michael, as testimony to CCIM, you did get one response, and it was our friend Mr. Mark Ilsley, and he put risk. So Mark, you win.
Yeah, but he put it in after I said it. So. I know how Mark works.
We're going to probably run a few minutes over since we got started a little bit late, but I wanted to, one of the things that I was on the phone yesterday with somebody that's, contemplating the sale of a nice, a $30 million, apartment complex. And he was, you got the right frame. You're headed where I'm going. So, we're going through some basic stuff, and I just want to put out there to everybody on this call right now, understand we've got a lot of different tax issues. We've got a proposal that would cap your annual tax deferral on 1031 at $500,000 per person per year. And, especially for, somebody like I'm just mentioning with this apartment complex at a $30 million ticket number, gains are going to be well beyond that. And the federal government's, their numbers on tax reform, they think if they cap 1031 and make some of these other changes, they expect an additional $2 billion roughly a year in revenue. According to Ernst & Young, our industry's numbers are probably tenfold the opposite direction. And that's for a variety of reasons. One of them Michael mentioned with just the property valuation and the taxes. But if you look at what's being proposed, the most scary thing to me, honestly, in addition to losses stepped up basis, in addition to going to mark on gifts and potentially mark on distributions of assets from limited liability companies, you've got that cap, but the tax changes. I mean, at the top level, you could have a tax change from a max on appreciation federally at 20% and 25% on depreciation recaptured, and some people could be looking at 39.6%. The scariest thing about this is right now we're hearing it be retroactive to April of this year. So, you know, Michael put up this purposeful investing slide. The gentleman yesterday is like, look, who can I talk to? Who's going to analyze this stuff? And you know, we've got most financial advisors are working in the Wall Street world, and real estate, as we all know, is a totally different situation. So your ability to, I mean, the guy that mentored me always, you know, I had, hey, you better answer 3 questions before you ever buy something. If you've seen our seminars before, you know what they are. What am I going to make? How am I going to make it? When am I going to make it? If you can't answer the questions, don't do it. Yeah. But, you know, are there people, you know, and obviously you're highly trained with the pin there, that will actually do financial planning for the real estate world and look at these different things that you've got up on the screen and go at it with knowledge and experience to help these people get where they want to go. And by the way, on the tax reform stuff, anybody that's looking to help or get more information, you can take a look at our YouTube channel there was a presentation we did last month on tax reform. I had the incoming president, national president of CCIM speak. And I also had a chief of governmental affairs for Inland Private Capital. So it's really good information from great sources. But if you're looking to help, you can take a look at 1031buildsamerica.org. Once again, 1031buildsamerica.org. And we really appreciate any help anyone out there can offer us. But, you know, Michael, why don't you take it from there?
Yeah, thanks. And, you know, if we're talking about taxes, or, you know, exchanges, obviously I'm going to talk to you because you're the expert on all of that. I'm just the numbers monkey, putting them all in there. But from that perspective, yes, you're talking about sort of a financial advisor for commercial real estate. And that's exactly how I had built my business. You know, I was in brokerage for a long time and then doing investments and so forth, you know, both for myself and for others. And what I found is that there's a huge disconnect sometimes between investment objectives and what's being offered in the marketplace. You know, there's a lot of brokers out there, and God love them, I was one for a long time, and I told you I made a lot of mistakes and over time. But you know, brokers aren't always investment specialists. They don't always quite know the things to look for, and really, when you're talking about it, they're not looking at it from a holistic portfolio view. And so that's how we're a little bit different. And when you're talking about financial advisors, you know, you sit down with your Schwab guy or your Merrill Lynch guy or whatever, or gal, they're going to sit down with you. And the first question that they're going to ask is, what are you trying to accomplish? And that goes to goal setting. And that's a big thing on how we approach real estate investing, because really what it comes down to is, you know, there's a lot of tools in the real estate toolbox, but what are you trying to accomplish? Whether it be, you know, increase cash flow, increase net value, leave a legacy portfolio for your kids and your grandkids. You know, it really just depends. And what that does is that leads us, after we sit down and we go through all of these and your experience and so forth, that gives us a risk profile on how we can drive the investment objectives. For example, if you are a risk-averse investor or in your late 70s, obviously we're not going to get you into a 10 cap multifamily in Oklahoma. You know, we're probably going to look at a low cap, some sort of triple net that has a low risk profile and has cash flow and some wealth preservation there. Obviously, it's going to be different if you're a 25-year-old investor and just trying to figure out where to go. So that all drives the acquisitions, dispositions, exchanges through you, David, and so forth. And so that's how we look at it. And you know, I've got an investor that is a client, and he's very successful. He's a retired doctor, and he's got 9 properties. I think we have roughly 70 million under assets. And, you know, when I first started working with him, he would get all these flyers from these brokers, and, you know, he would send it to me and he'd go, do you think this is a good deal? And the first question that I always asked him was, well, what are you trying to accomplish with it? And he would send me these, and they were like shiny objects, right? You're always trying to, wow, that's a really nice shiny object. But I would say, if you buy a travel trailer and you're going down the road and you got to go get a truck to pull the travel trailer, but you're going down auto row and you see, oh, the Toyota Priuses, holy cow, they're giving $5,000 off, and look at that gas mileage. Wow, that's really incredible. You go in and you pull. Now, did you get a good deal on the Prius? Well, sure, you got a good deal on the Prius, but it's not going to help you tow your travel trailer, right? The same idea with real estate is that there's a lot of good deals out there. There's a lot of bad deals out there too, but there's a lot of good deals out there. But does it help you accomplish what you're trying to accomplish with your real estate portfolio? And I think that's one of the bigger takeaways for a lot of what we do and how we look at investing in real estate. So hopefully that answers your question.
Yeah. So Mark had a comment. He said every tenant has a risk perspective from a buyer in a multi-tenant property. I guess so. It's less a question than a statement, or he's asking a question in the form of a statement.
Okay, I didn't quite get that. You say that again?
Every tenant has a risk perspective from a buyer in a multi-tenant property.
Absolutely, absolutely. Every player in it has a different risk perspective. So your investor has a risk perspective, your tenants have a risk perspective, your lawyers have a different risk perspective, your broker has a different risk perspective. It really is that. It's a perspective on how you're looking at it. So yes, absolutely. You and your tenant are not always going to be on the same page, and that's where getting a good broker and good negotiations comes into play.
All right, we've got one more question coming from Brian, and he's just asking whether you could clarify the four. He'd like you to clarify the four most common ways cap rates can be manipulated.
Yeah, so wrong year cash flow. I've seen that where the cap rates are based off of the previous 12 months. That's not what you're buying. You're not buying the investor that's selling you the property's cash flow. You're buying your future cash flow for 12 months. So I've seen that play out. The other one that I've seen is the pro forma numbers. Once again, trust but verify, I guess, is the best thing you can say. Once again, if there's pro forma numbers in your offering memorandum, I would question why and why it's not based upon real numbers. If, like I had mentioned, if you're buying pro forma numbers, why didn't the last owner do it? Okay, so that's one. Price versus value. That's one I didn't really get into, but the cap rate is based on property value. It's not necessarily based on the acquisition price. There's good deals, there's bad deals. And so making sure that you're basing the cap rate off the actual value of the property, that might mean getting an appraisal or having somebody evaluate it from my perspective. And then the wrong expenses, and that's the biggest one. Basing cap rate and basing your NOI off the previous owner's expenses is a recipe for disaster. And so I just, task you with making sure that you understand what expenses are going to go into the property once you purchase them. And also understand, some of the capital improvements that you're going to have to make as you go along. So those all affect your investment yield.
Yeah. So what's interesting to me is the IRA 401k side of our business. If we're looking at loans in that space, it's got to be non-recourse debt. But the banks that provide financing in that space, they want people with experience. And I think what you've expressed today is, or everybody should be walking away from this. Like I said earlier, it's a snapshot a given period of time, and it's the current owner's snapshot. If you have no experience, you really don't know what to expect in a given region or asset class. Your numbers are going to be different than what theirs are. So it's really critical that you have somebody doing numbers on your behalf.
That's right.
So,
and we work with, we work with investors, we work with fiduciaries, we work with brokers too. I mean, if brokers ever want us to, sort of crunch the numbers, so to speak, make brokers look really good, we can help with those as well. But the overriding thing is we really want to increase the level of knowledge and education in our market, because I think that makes everybody better and helps increase the value for commercial real estate.
So you've got something on the screen here. Why don't you tell them what you got going on? And I guess I'd like to put out there to everybody. I mean, if you're interested in more on CCIM or that sort of the CI 101 class is sort of the class that gets all this stuff taken care of for people. Can you explain, what people would need to do to get into that? Do you have to be a broker? Do you have to be,
No.
what do you need to be able to take one of these classes?
Yeah, great question. Thank you, David. So our chapter is offering a CI 101. So a lot of the ideas, and I haven't even touched on a lot of these. I do in this class, and that's why I put it up here. But investment, internal rate of return, net present value, huge metrics that are used in investment real estate. We'll dive into a little bit and give you a little taste. But the CY 101 is going to give you a very in-depth education on investment metrics and how to look at it. And we run the gamut. We do internal rate of return, before leverage, after leverage, before tax, after tax. I mean, we go through everything with CI 101. So we're actually offering a class here in the Portland area. October 25th through the 28th. It's on our CCIM, OregonCCIM.com website. I'm doing something just prior to that on September 15th, which is what I have up on the screen. This is sort of an intro to 101 to a certain extent. It's both an intro, and it's also going into a little bit of a deeper dive on the risk analysis side, which is what we do a lot of. So we're going to be talking about different types of risk. We're going to be talking about how we mitigate those items in your portfolio. We're going to be talking about discount rates. I really hadn't been talking about discount rates much today. We just mostly talked about cap rates. Variance in differing risk outcomes. We're going to talk about some basic supply and demand forecasting and understand what numbers you're going to be putting into worksheets. And then net present value and yield analysis. And we're going to take real life examples. I pulled these properties off of Crexy that are right here in the Portland metro area, and we're going to go through and we're going to dissect those and hopefully come up with a way that you can at least get a different perspective on how you evaluate commercial real estate. So you can go to orsci.net/education and sign up there. But also,
Michael, are both these open to anybody?
Open to anybody. Open to anybody. Yeah, there's a little bit of a misnomer with CCIM, and I'm really trying to change that. When I go and I teach across the world, it's brokers, sure, but it's a lot of investors, it's a lot of fiduciaries, it's a lot of CPAs, it's a lot of port authority people, it's a lot of servicers, a lot of bankers. So CCIM education, the designation is not particular to, if you're dealing with anything in commercial real estate, you're going to find something that's relevant. You're going to be 1,000 times smarter than when you went in. So,
well, thank you. And I think we'll wrap it up right now, unless you've got anything else you'd like to add. Michael, I'm sure you're willing to speak with people if they've got questions.
Oh, yeah.
And Celia will get here's some contact information. Celia will get information out. Anyone on this call that's looking at CE from a region that we can provide a real estate CE, please let Celia know. You can reach her at cmore@1031exchange.com. Please take a look once again at 1031buildsamerica.org. The reason it's called that these days is you think about, back to Michael's comments earlier about, taxes going up on transactions. One of the biggest issues historically, 1031 is 100 years old, and we're, under attack yet again. And one of the biggest issues that's coming up is if you take it away, it destroys market liquidity. And the problem there is every time a property is sold, the buyer of that property typically is going to improve those properties. And if we've got regions like we're sitting in here with real high rent control laws, we have owners that no longer have the financial ability to take care of these properties in a lot of cases. So this is something where we're very concerned. If people can't move properties, we don't have new buyers coming in, taking care of those assets and keeping those older properties vibrant. And it's sort of ironic that a lot of the brand new construction's exempted from these rent control issues, and the old stuff that needs the help is subject to it. But whatever you can do to help us out, we're very appreciative of. And like I said, be aware if you're selling something right now, talk to your tax people. It's critical you talk to them. You understand that we are in a flux period. We don't honestly know at this time what the tax consequence is going to be, what the tax rate will be come year's end. So we've got a very hot market, lots of properties moving. Obviously, the people doing exchanges are trying to get them done before any cap on deferral is going to occur. But I just want to warn people, if you think you're going to sell and pay tax at the current rate, I really can't stress enough. Talk to your tax people about it. Get a good understanding so you're not finding yourself in a situation where you thought you were paying one tax rate, now you're staring and looking at a whole different one. So, Michael, any closing comments you'd like to make?
No, just I'm open for questions, or if you want to give me a call. But David, I really appreciate you being out on the forefront of all of this, and you're one of the people, national leaders on this, and the policy changes that are coming down the pike and really organizing people. So we appreciate you doing that for everyone. And but no, I just appreciate the time today. And like I said, if I can be a useful resource, just let me know.
Well, I like to say, like I said earlier, little nuggets of knowledge, and the snapshot comments, my nugget of knowledge from you today. So I really appreciate that. I always like to say the only dumb questions that's not asked is the one that's not asked. So if you've got questions that Michael can help you with, please don't hesitate to reach out to him. If you got some questions that I can help you with, I'm always here. But thank you very much, everyone, for attending today, and hope everyone's going to have a great day, and best of health to everyone out there. Thank you, and look forward to working with you. Take care. Thanks again, Michael.
Thank you.
Bye-bye.